Welcome back. You're still watching Markets at Noon, and let's now talk about the fundamentals of the market, looking at the current scenario. What should be a strategy for the long-term play? And to talk on the same, we have with us Siddharth Vora, Head Quant Investment Strategy and Fund Manager, PL Asset Management. Siddharth, good afternoon. Thank you for giving your time to ET Now. Pleasure talking to you this afternoon. Mansi Dave this side. To start with the positives, at present, we have a lot of domestic positive triggers where we see the trade negotiations seeing some good light and hope, where India and US representatives are talking and trying to come up with some conclusion on the same. And also the central bank decisions, US Fed, Bank of England, Bank of Japan are all slated for this week. So a lot of triggers which the market has to digest. How do you see the picture of the market amidst all of these?
So, we've been quite constructive on the market for since the last 3 weeks. We finally turned bullish on the short term, medium term, and we were always bullish on the long term. So almost after a year of staying in a, risk transition, risk off zone, we've turned extremely bullish over the last 2 weeks. Multiple triggers once again, as the dialogue and the offensive of Trump changed over the last 10 12 days from being hostile and offensive towards India in terms of tariff, towards being accommodative, towards being a little more open, towards a softening tone, that itself was enough to give direction to the markets. And I think FII flows and tariff uncertainty was the biggest overhang for India. Now, as that starts to resolve, I think most other things are already in good shape for India, whether you talk about domestic macros, the interest rate cycle in India, low inflation regime, tax cuts, GST reforms. I think across the board, we are seeing a setup where fundamentally macros are very stable, very robust. Geopolitically, things are improving. Domestic flows have been very good. Earnings will come incrementally from consumption as opposed to capex oriented sectors which we saw for the last 4 years. So the burden of growth is likely to shift, but growth is likely to surprise us on the upside. And quantitatively also we see a sentiment improving across multiple indicators, risk appetite improving, and valuations are neutral. So all in all, it's a very decent to good setup for markets to come out of the consolidation zone and stay positive and stay bullish.
Hi Siddharth, Ankur this side. You mentioned about growth. While growth will be there, the expectation will be that this consumption will lead to earnings growth. And hence, the expectation of market participants will be, when will we make the new high? Is it going to be in 1 year, 2 years? What is your time frame?
I would love to put a time frame to it, but usually time frames surprise us. Sometimes around Feb and the first week of March, we thought over the next 6 to 12 months, we will see a strong market recovery because all our quantitative indicators were suggesting that markets are oversold and we are setting up a good base for recovery. We pretty much recovered in 2 or 3 months itself. So I think we're not so far away from a new high at this point in time. And with the triggers improving, with the setup improving, who knows, it could be 1 month or it could be 6 months. I would love to put a number or a time, but I don't think I can. But I think we're in a good shape to make a strong recovery from here on.
To hear that, Siddharth. And also now let's talk about the sectoral positioning. What are the sectoral approaches for you? Where are you overweight? Where are you underweight? Where would you ask the investors or advise the investors to enter and consider entering as an opportunity if they get one? And what is the advice to stay away from?
So I think let's start with the advice to stay away from. I think extremely low beta sectors and probably IT. These are two sectors one can try to stay away from for now. Uh, Try to position yourself towards higher beta sectors. Higher beta sectors always do better when markets recover. And I think we are clearly coming out of a regime where low beta sectors did very well, a low beta portfolio did very well, and now we are moving into a regime where higher beta sectors would do well. In terms of our portfolio, think the broad positioning is materials has been the biggest overweight for us. Materials covers everything, metals, mining, cement, chemicals. That's been a big overweight position for us, followed by financials. Within financials, we're slightly differently positioned. We have asset managers, NBFCs, capital marketplace, and insurance companies. We've stayed away from banks for now. So financials has been the second overweight, of course, followed by auto, consumer discretionary, industrials, and healthcare. So this is how the portfolio is positioned at PL. We are happy to stick out these positions for some more time because all these sectors have very good triggers in place and the valuations have also not gone haywire so far.
Siddharth, while India remains one of the top destinations as far as the macro indicators are concerned, we have posted the best Q1 GDP if you talk about the peers, but still FIIs are going away. There is a figure which we cannot deny. So, do you think in the next half, meaning in H2, FIIs will come back compared to what they are investing in other markets?
So I think FII flows chase just three things only, right? It's growth, valuation, and risk. So India in the last 12 months was in a zone where there was a slight uncertainty on the growth tapering off. Valuations versus other emerging markets were extremely rich. And due to geopolitical factors, tariffs, India, Pakistan conflict, lot of small things, the risk factor with India also went up. So risk was elevated. Valuations were slightly uncomfortable compared to other emerging market, and growth had the uncertainty of tapering off. So all three factors worked against India. Now, as we stand today, valuations are neutral. They're not great, but they're neutral. They're not a concern anymore. Growth triggers are in place, and uncertainty, risk, geopolitical triggers are getting settled. So I think all the triggers that worked against us over the last 12 months are starting to get back in favor. So I think FII flows can't avoid India for too long.
Absolutely, and at times we also discuss the same, Siddharth, where we think and keep thinking whether our FI is missing an opportunity to enter an emerging market like India. But then, yeah, we'll keep an eye on that as well, and DIs are constantly supporting their domestic markets. But at the same time, taking a little ahead from where you were talking about the IT sector, you said as one of the underweights and one of the themes where you're underweight is the IT sector. Now, what do you think is happening with the global IT giants? Because the technology heavy index in the US, NASDAQ is performing really well and the IT sector over there is doing really good. Why then there's no eventual impact as we see in the domestic IT place?
So, now the term IT, which we know in India, is basically fulfilling services for bigger, businesses and tech companies outside India. We are actually a service oriented IT play, whereas in US it's product oriented IT and AI now. So I think India is still not geared up fully. The Indian IT services company are still not geared up fully for the AI wave. And the last time IT in India did really well was when cloud adoption was the big theme. And as of now, of course, cloud is going to continue to be a big theme, but AI is the even bigger theme. And in the world of AI, layoffs are mainstream because the standard programming and servicing is not going to be a very highly value added skill going ahead. And therefore, layoffs are going to be very huge and rampant across US and India, and the capabilities needed to deliver on AI projects are slightly different than those were needed for other simpler or just programming projects. So I think there is going to be a big shift going ahead in how IT in India has to completely revamp its skills, its talent pool, and its capabilities to stay relevant in the next 4 or 5 years. AI is going to be adopted much faster than some of the other, prominent technology waves that have taken place in the world in the last 10 years. So it is going to be a challenging environment, I feel.
Right, Siddharth, one more important event is coming up in terms of Federal Reserve's meeting, and the expectation this time is that there is going to be easing 50 basis point cut is possible. How do you assess the impact on global market due to this news?
So usually rate cuts benefit emerging markets, except the last two times it didn't benefit India, but it did benefit other markets like, China and South Korea and Taiwan. As, tariff uncertainties start to wane off, I do believe India will also, be a big beneficiary of potential rate cuts. And, nonetheless, the dollar index has been weak. The broad rate outlook in US has softened and rate cuts look like they're going to be priced in the near term. So it is going to be positive for equity markets globally and especially emerging markets.
Okay,
Gold is going to be a big beneficiary, though. Gold is going to be a big, big beneficiary.
absolutely. Siddharth, that felt like a 360-degree insightful conversation. Thank you so much for joining with us and giving your views on the markets, both global as well as domestic. Thanks a lot and have a nice day to you. Moving ahead and talking about an exclusive, Sajid Mangat caught up with Gopal Kabra, CMD and CEO GK Energy to discuss the IPO offerings and their business outlook. Let's listen in.